Most people who have a good CPA assume their tax situation is fully handled. But what actually gets handled is the reporting of what already happened, not the shaping of what could have happened differently. A CPA takes a fixed set of circumstances at the end of the year, runs the numbers in a very precise black and white way, and gives you the output based on the tax code. Income came in, gains were realized, deductions existed or they didn't, and the return reflects exactly that. If the inputs are set, the output is set. And a good CPA will get you the right answer every time. The part that gets missed is that those inputs are not fixed until year end. And many of the decisions that determine your tax outcome are happening throughout the year, long before anything gets handed to a CPA. The timing of when income shows up, which positions get sold and when, how equity compensation is handled, what sits in a taxable account versus a retirement account, whether charitable giving happens with cash or appreciated stock. All of those different types of decisions shape the end result in a way that no amount of clean reporting can fix after the fact. A very common version of this shows up with short term gains in a high income year. Someone has a strong year at work and receives a larger than normal bonus. At the same time, they have a position in their portfolio that is appreciated quickly and is sitting on a meaningful short term gain. That gain gets taxed as ordinary income, which means it stacks directly on top of the bonus and everything else that you would have earned for that given year. If that position gets sold in that same year, the gain gets layered on top of an already elevated income base, and a larger portion of it gets taxed at a higher marginal rate. Nothing about the tax treatment changed, the sequencing did. If you zoom out a bit, that is where the opportunity sits. The decision is not just whether to sell, it is when that gain shows up on the return and how it interacts with everything else that you have going on that year. If the position is something the person still wants exposure to, you can look at whether it makes sense to just hold on to it long enough to cross into the long term tax treatment. You can look at whether there are losses elsewhere in the portfolio that can be realized intentionally to offset part of this gain. You can decide whether it makes more sense to spread the sale across different tax years rather than forcing everything into one high income year. There are also situations where it might make sense to hedge the position instead of outright selling it. That allows you to reduce the economic risk of the position while deferring the realization of the gain, which can matter if the goal is to avoid stacking short term income on top of a year where income is already unusually high. The structure has to be done correctly, but the concept is pretty straightforward. You are separating the investment decision from the tax timing. None of that changes the tax code. Short term gains are still taxed as income. The brackets are still the brackets. What changes is when that gain becomes taxable and what else it sits on top of. Timing alone creates opportunities most people never think about. Realizing a large short term gain in a year where income is already elevated pushes more of that gain into the highest brackets. Realizing that same gain in a different year where income is lower produces a different result entirely, even though the asset and the gain are identical. Once the calendar year flips, that decision is locked in. The same idea shows up across the rest of the portfolio. If markets pull back during a given year and cause some positions to dip below their cost basis, harvesting those losses can offset gains elsewhere in the portfolio. If no one is paying attention to tax consequences, it's easy to miss these types of tax optimizations. A CPA will absolutely use the losses if they exist, but they typically aren't in the business of making sure they get taken properly. This is where the role of a financial advisor comes into play. Our job is to be in the middle of those decisions in real time throughout the year. An advisor proactively plans for what income is projected to be each year, tracks gains and losses as markets move, considers whatever is happening in someone's career or business, and makes small adjustments throughout the year that improve the numbers that the CPA will crunch each April. Most CPAs do not spend time on that type of forward looking work. They're focused on preparing returns, staying current on the tax code, and making sure that filings are accurate and compliant, which is exactly what they should be doing. Two people with nearly identical incomes and investment portfolios can end up with very different tax bills each year, even when both returns are perfectly accurate. The difference comes down to how decisions were handled throughout the year. One might have had a thoughtful strategy around mitigating taxes. The other might have just allowed things to unfold without planning much around taxes. And the gap these two different approaches causes can be pretty significant. Once December passes, most of those decisions are no longer available. You can file extensions, you can make a few limited adjustments. The majority of what determines the outcome needs to be done in real time and cannot be done retroactively once the year is already closed. This is exactly the kind of coordination we focus on at Valorum. We work alongside our clients' CPAs to make sure the right decisions are made before the year closes. If you want to make sure you aren't missing any tax optimization opportunities, please feel free to book a call below.